Tobacco is addictive, and that's why inflation doesn't halt cigarette sales. The only thing that can stop it is government policy. And tobacco companies have outperformed the overall market this year, and many of them offer incredible dividends. So it's no surprise that financial pros have been investigating these defensive stocks on Trackstar, our proprietary stock search database. Altria Group has been the financial pros' top tobacco company search over the last month, but many investors have ethical issues with the company, so we'll leave it up to you whether a stock like Altria is right for you. Nevertheless, for those who are thinking about picking up the stock, consider the following. Altria Group is in the cigarettes, cigars and smokeless tobacco business. It also has strategic interests in the alcohol and cannabis industry. The company sells products in over 300,000 retailers across all 50 states. In 2018, Altria took a 35% stake in vaping company Juul for $12.8 billion, and after multiple write-downs, the company recently valued that investment at a mere $450 million. And while sales of vaping products have risen, the FDA continues to work hard to limit their availability and impact. Altria has had rather flat revenue growth over the last 8 years, but not for lack of trying. In 2013, it made $24 billion in revenues. In 2021, it did $26 billion. However, 2022 has been hard. The firm has made $20.7 billion over the last 12 months. The company has boosted its dividend over the years. It's currently a whopping $3.76 per share, or a yield of 8.28%. And it has $2.5 billion in total cash and $27.6 billion in total debt. Understandably, its current ratio of 0.49x isn't pretty. And Altria trades at a bloated 46 PE gap ratio. However, its forward PE gap ratio is 10.8x, which is more in line with its competitors. Additionally, Altria trades at a price to sales ratio of 3.9x, notably better than Philip Morris at 4.2x, but not as strong as its other peer groups. Altria has a gross profit margin of 67%, but its net income margin of 8.4% isn't that impressive when compared to its rivals. That's largely why Altria beats its competitors with an EBITDA margin of 59.4%. Altria's year-over-year revenue growth has fallen 7.4%, while its competitors have been able to grow revenues in this tough market environment. However, Altria's year-over-year EBITDA growth is positive at 0.96%, notably higher than its peer group. In our opinion, this is a 4 out of 10 ranking stock. And with a dividend yield of 8.28%, Altria might seem like a good place to park your money during market uncertainty. The company's stock is only down 4% this year, outperforming the S&P 500. But the firm's top revenue maker is getting phased out over the next few years. Plus, the company carries $25 billion in debt, which used to be $12 billion. That extra debt brought a stake in Juul, which flopped badly. With more than $39 billion in long-term liabilities, $8.3 billion in short-term liabilities, and only about $2.5 billion in cash, the company's $8 billion in annual cash flow from operations won't cut it. What will get cut is Altria's dividend.